All right, hey everybody, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in this video here, I'll be talking about the three major signs or indications that short naked option strategies, like for example, strangles or straddles, ratio spreads, or just a naked call or naked put, that those kinds of strategies might be a good fit for you. And that's going to be based on things like your overall risk tolerance or the amount of capital you have at your disposal, your level of experience, and things like that. But as always, before we dive in here, in case you are brand new to the channel, again, my name is Scott, and I just want to let you know that you can also find me on Skillshare as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for Skillshare using any of those links, you'll get a full 1-month free trial. All right, so now diving in here, and the first major sign or indication that these kinds of strategies might be a good fit for you, and this one should hopefully be a bit obvious, but that's if you have a complete understanding and desire for both the risks and advantages that come with these kinds of strategies. Now, what exactly do I mean by this? Well, essentially the main risk that comes with just selling a call or a put with no stock position to go with it is that you have, theoretically speaking, unlimited loss potential. And of course, that could certainly sound a bit scary for plenty of new options traders, but as I've said in many previous videos, that's only the case. You only have this undefined risk aspect with naked option strategies if you do nothing to defend the trade, right? So yeah, if you just sell a call or a strangle or whatever, and you do nothing by the expiration date, sure, in some occasions, you might have catastrophic losses. And so that's why a critical component of your overall understanding of these kinds of strategies is to have a very concrete and well-defined plan in place so that you know exactly what to do in all kinds of situations. Right? So for example, it's obviously very easy to just, kick your feet up and relax when things are going very well, right? When all your positions are going as expected and you're just making money every day or every week. And trust me, those times will come, and definitely enjoy them. But obviously also those good times will always come to an end. So it's especially important when things go wrong, when your trades move against you and you start racking up losses, that you know exactly what to do to defend your positions. And that defense could come in the form of things like just buying back your contracts and cutting your losses. That's certainly a very easy thing to do. You could also, for example, if you sold a naked call, you could eventually buy stock at some point to defend the trade, or you could also sell a put option against your call to basically delta hedge your contracts. Doesn't matter what you choose, but you need to have a concrete plan and stick to it. And again, that's because, just to reiterate one last time, if you have no concrete plan or no defense, then chances are when things go south very, very quickly, you're going to rack up catastrophic losses. And that's obviously not what you want to have happen. But that being said, if you ask me, the advantages that come with these kinds of strategies greatly outweigh the few added risks involved. So just briefly to go over those few major advantages, that includes things like you'll have a lot more variety of strategies at your disposal. Right? For example, you'll now be able to sell strangles or straddles, ratio spreads, or just sell a short call or a short put by itself. So tons of new and different kinds of strategies that you can use. You'll also have greater profits because, of course, when you sell a naked contract, you'll collect a much greater credit. And that's because, of course, you're not paying any money for protection, like, for example, buying an option as part of a credit spread or an iron condor. On top of that, you'll also have a greater chance or a greater statistical probability of making a profit. And again, that's because of the greater credits you will receive for selling these naked contracts. And also because you can sell these options with strikes much further away from the current stock price and still collect a very high credit. And so therefore, because you can sell options further away, that's just inherently going to give you a greater chance of those contracts expiring worthless and you walking away with that credit. Moreover, making adjustments to your existing trades is going to be far easier because you're dealing with way fewer contracts, right? There's no long options to worry about, and therefore the additional or adjustment credit you will receive is going to be greater. And also, of course, your commissions will be way less as well because, again, you are dealing with fewer contracts. And then finally, you will also have full option Greek exposure, specifically to delta, theta, and vega. So basically, this means your positions will be much more sensitive to a move in the stock price or implied volatility, time decay, things like that. And ultimately, that translates to much faster profits if you are correct, or also faster losses if you are incorrect on the trade. And so, like I said, I do personally think that those advantages far outweigh the undefined risk aspect that come with selling naked options, as long as you have that concrete plan in place to know how to defend your trades, and you do have a very in-depth understanding as to exactly what you are doing. And so now next up, the second major sign or indication that these kinds of strategies might be a good fit for you and your trading style is the time commitment. In particular, and this is a general statement of course, but in my opinion, you should be prepared to spend at least 30 minutes every day, Monday through Friday, to log into your platform, your trading platform, and to make new trades and assess what's going on. And it definitely is up to you how you want to allocate that time. For example, if you want to spend all 30 minutes at the market open, or perhaps just at the market close, or even in the middle of the day, totally up to you. But in my experience, I do think it's best to allocate maybe half that time at the market open and then the other half of that time at the market close. The reason being is it's during those two times, market open and market close, when the most trading activity happens, and consequently stocks will move the most as well. So again, I personally think market open and market close are the best times to make your new trades or any adjustments you want to make as well. And also, a second reason why I think you should log into your platform at least once every day is because short naked option strategies are typically meant to be very short-term strategies, right? For example, when I sell options, I typically do so with less than 3 or 4 weeks to expiration. And so as a result of that, daily price fluctuations or weekly price fluctuations definitely do matter. Right? For example, one day your strangle might be totally fine, and then the next day things might be going crazy. The stock might move by 25% on earnings, for example, and at that point you might have to take some immediate action to defend that trade. So again, make sure you're able to allocate at least 30 minutes every day, Monday through Friday, to manage your portfolio. And then also, just to give you an idea of the kinds of things I personally do during that time. For example, I'm always scanning the markets, looking for new trades, new opportunities. And through that process, I'm doing things like technical analysis on the price action charts, or looking at implied volatility, or setting up alerts to notify me when certain stocks reach those opportunistic situations that I'm looking for, things like that. I might also be adjusting existing positions, which, as I mentioned previously, could come in the form of things like buying or shorting stock. You could also roll your contracts out in time to the next expiration cycle and adjust your strikes at the same time. Or you could also sell calls or puts against your existing contracts to hedge your deltas and collect additional credit. And then finally, I do also briefly scan through the latest market news and events to see when, for example, there's upcoming earnings announcements, or just to read headlines so I can stay informed as to the major things that are happening right now. And then finally, the third major sign or indication that short naked option strategies might be a good fit for you, and this one honestly is the most important in my opinion, is if you meet the capital requirements. And this one is both objective based on the requirements set in place by your broker, and then also subjective based on my personal experience and opinion. So for example, with TD Ameritrade here, which is my personal broker, if you do want to sell strangles or naked options with them, you must have a margin account, which anybody can open, and also at least $5,000 in that account. And then on top of that, there is a separate approval process where you have to fill out an application and answer some questions and ultimately get your final approval. And also, just as a side note here, I do have a separate video that will show you the best way to fill out the application to give you the best chance of that approval. I'll post a card above linking to it so you can watch it later. But again, the minimum objective requirements are a margin account and $5,000. Now, that being said, I personally do not think that $5,000 is enough. And that's because number one here, if your account drops below 5,000, even by just 1 penny, you're going to lose the ability to sell naked options until your account returns to above 5,000. So therefore, you do need some cushion above 5,000 to accommodate your account dropping in value a little bit just because of general market fluctuations and things like that. But to get a bit more specific here, I think at least $10,000 is probably a very good starting point, because with this amount of capital, you are still going to be limited to selling options on pretty cheap stocks, anywhere between maybe $10 per share and at most $25 or $30 per share. And generally speaking, if you do want to sell, for example, a strangle on one of these stocks, the initial buying power requirement or the initial capital requirement is typically going to be anywhere between $100 to $300. And in my opinion, it's not wise to allocate more than 5% of your portfolio, your total account value, for any one position. So therefore, if we take, for example, that $300 on the higher end there, divide that by 10,000, your total account value, that equals 3% of your account, which obviously is less than 5%, and that still gives you some room for that buying power to possibly expand. right? Because again, I said the initial capital requirements might be $100 to $300, but if the trade moves against you, that buying power will expand and it could go to 5%, 6, 7%, or even beyond that in some very bad situations. So once more, having some built-in cushion for each one of your trades to again accommodate increasing amounts of risk, I think is always a good idea. And always keeping your risk small to begin with is a great idea because if one or more of your trades do blow up, you can still recover from that without too much trouble. And then finally here, having adequate diversification amongst all your trades is also very important. So for example, I don't think it's wise to have only 1 or 2 or 3 trades on. In my opinion, having 7 or 8 or even more than 10 is a good way to have adequate diversification. So therefore, if each trade, let's say, is taking up 3% of your buying power of your total capital on average, then 10 trades times 3% per trade is 30% of your account being allocated at one time. And with a portfolio consisting of naked option strategies, 30% of your account being allocated for those positions is definitely a bit conservative, but you also don't want to go too high either because of that expanding buying power potential. Because one of the worst situations you could possibly find yourself in is, let's say something very bad happens in the market and you face a tremendous increase in your capital requirements for your short option positions. You might find yourself running out of capital if you are over allocated, right? Once you get to a point where you're using 100% of your capital and your broker still requires more on top of that, you either have to deposit more capital very soon, or you run the risk of your broker coming in and shutting down your trades at very, very bad prices and leaving you with very catastrophic losses. So that's why ultimately, in my opinion, it's best to be on the conservative side of things and leave yourself with a lot of spare capital on the sidelines to accommodate a possible huge increase in capital requirements. And so with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my Skillshare courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.